Hi, everyone. Thanks so much for checking out my show, Coin Stories, where I get to hear from the leading voices in Bitcoin, financial markets and investing, political structures, philosophy, and more. Please make sure you're subscribed to the show. And if you're watching this on YouTube, like the video so more people see it, and hit that notifications button so you don't miss out on any new content. This podcast does not provide financial advice. It is for educational and entertainment purposes only. So make sure to do your own research before making any investment decision and be aware of your risk tolerance. I'm able to produce this show thanks to my sponsors, and I'm very picky about who I choose to partner with. So I hope you take the time to listen to the ad reads throughout the show. All right, now to my first partner, where I buy my Bitcoin, Swan. I partnered with Swan because it is a Bitcoin-only company focused on helping people save for their future and self-custody their Bitcoin, not trade it. You can start a direct deposit to take advantage of Bitcoin as a savings technology and learn how to take it off the exchange. Swan's mission is to educate 10 million future Bitcoiners through free resources and media projects like Hard Money. Swan also offers retirement planning with an IRA, tax loss harvesting, home equity conversion, and a white glove private client service. I use Swan to dollar cost average every day. That's right. I deposit a little bit every day that's equivalent to what I might spend on a meal so that I add to my future nest egg and lower my yearly cost basis. To learn more and get $10 in free Bitcoin when you sign up, head to swanbitcoin.com/Natalie Brunell. All right. I am really looking forward to having Sven Henrich back on the show. Sven, how have you been?
I've been doing great. Running a lot, exercising, it's good stuff. And since the market's been chopping for like 6 weeks, it's been kind of easy just playing the ranges.
Well, I hope that you can clarify what's been happening, because I, for one, am super confused why we haven't crash landed yet. I'm going to share one of your recent tweets. You said, the greatest trick the devil ever pulled is convince the world inflation can be beaten with no recession and the unemployment rate staying at 3.4%. I mean, the labor market's strong. We had, a couple of banks, nothing too crazy, but we seem to keep going. And, there are tech stocks booming. Bitcoin's doing pretty well. Gold. What is happening in the markets?
Well, in a way, it's kind of what's been happening in every major cycle. I mean, I know people keep talking about recession and they want instant gratification, and maybe that's a shortened time frame it's demanding that. But the reality is, if you look historically, these things take time. I mean, look at 2006, 2007. Fed raised rates to kind of the similar levels, same levels as they are now, and nothing bad happened until 2008. Now, mind you, back 2006, 2007, debt to GDP was half compared to what it is now. This is a very different economy. And of course, the rate hike cycle this time around a lot faster. And you see some of the consequences now, as we saw in the banking sector. And you can blame executives of banks all you want, but the reality is the Fed literally guided everyone in December of 2021 to say we're going to have an effective Fed funds rate below 1% by the end of the year of 2022. They did that. Nobody else. They did that. Okay, so this isn't just a long string of events of the Fed misguiding the market, being caught, short-haired by actual economic developments. And I'm saying, that these cycles take time. There's a couple of big sledgehammers that everybody seems to be ignoring. Just because nothing bad has happened as a result of these rate hikes doesn't mean it's not going to happen. These rate hikes work notoriously slow through the economy, 12 to 18 months in general, okay? They just started raising rates last year. They really didn't get really aggressive until in the latter part of the year. So we haven't seen at all the full effects of these lag effects yet. So everything you're seeing is in the rear view mirror in that point. And of course, when you get a rollover inflation, you get some optimism with that. The worst is over. That's the kind of relief rally. Now, if I look at the market, actually, which is interesting, and we were technically very bullish from October because we saw all these bullish patterns and this, that, the other. Mid-April, I started getting cautious because what I want to see in a market that is recovering in a great way is I want to see participation. I want to see, you know, if the soft landing, no landing narrative is all true, then I should see it somewhere in the charts. I ain't. What I see is 10 stocks driving everything. An equal weight, which is if you measure the entire market on equal weight basis, a complete disaster underneath. So, you know, the question you kind of have to confront yourself with, okay, who's telling the truth here? You know, Apple, Microsoft, Google, you know, these guys, or the broader economy, which is much more sensitive. These companies have fantastic balance sheets, and they've become the safe haven as you run into bank troubles. You know, so we're all, including the Fed. Let me be very clear here. The Fed does also not know what the full impact of these lag effects are. They don't know. Nobody knows. We're all part of the experiment here. Let's take the fastest rate hike cycle into the highest debt construct ever, and yeah, let's hope for the best. Okay. The second sledgehammer is what just happened with these regional banks. The credit tightening that's coming from that, we are going to see that still coming through. Okay, that also takes time. And you know what's kind of really hilarious and terrifying at the same time is how, and I'm not predicting a 2008 like crisis, but what is fascinating is the parallels in the events and the narratives that are taking on at the same time. And one is Bear Stearns in 2008, it happened on the same weekend as SVB, right? S&P rallied 14.5% into the middle of May, right? The great counter rally. Why? Because they intervened. And guess what they just did? They intervened, right? And the Fed actually, ironically, sent probably the most dovish message it could without intending to do so. But the message was, as soon as anything goes wrong, we're going to go balls back into expanding liquidity. And that correlation between liquidity and markets has been spot on since in the lead up to the bubble bursting, and then the bear market we had last year. You know, and so when you throw in $400 billion in liquidity in a matter of days, it's going to have an impact. You know, it's going to make things look better. And that's what happened in 2008, when everybody was so keen on making sure we're going to keep confidence up by saying everything is safe and sound and stable, which is exactly what you're hearing now. Okay, because they have to say that. They have no choice. No one's going to go out from the Treasury Secretary or the Fed chair and anyone else and go, oh, things are unstable, things are bad. They're not going to do that. They don't want to panic. The whole point of the exercise is to prevent a panic, right? And so I feel like we're in this phase where, you know, you got the sweet talking, the soft talking, you got the interventions. But if I look at bank stock charts, they're not showing that everything is hunky-dory here at all. And you know, the emphasis here seems to be to say, okay, the big banks are fine. It's only the little banks. Well, I got news for you. First of all, just look at the stock charts of the big banks. The best one on the bunch, actually the one that arguably has benefited the most from all this so far, is JP Morgan, right? The stalwart of the banking sector. It's up 3% on the year, which is great compared to all the other banks, but compared to an Apple or a Microsoft, it's completely lagging. And two, and I'll finish off on that point, when you want to, you know, kind of push aside the regional banks as not being important, I got a rude awakening for you. Regional banks, small banks in the United States account for 50% of all commercial and industrial loans, 70% of commercial real estate. They may be smaller compared to the big ones, but they play a really important part in the United States economy. And so when you have the combination of lag effects of rate hikes still coming through, and now this wall of credit tightening, lending standards tightening coming in, you got just a toxic combination of slowing growth, which is happening anyway from, you know, the tightening of the entire monetary, liquidity flows, M2 money supply, you name it. So I feel like we're all kind of, not seeing the iceberg. We kind of know it's there, but we're kind of ignoring it, right? So that's why I'm kind of on the macro front saying that whatever rosy picture we may want to believe, while it may be true, miraculously, it's not consistent with history. Although that history also says we have these episodes, especially at low unemployment, where everything is fine. And it's the point when low unemployment all of a sudden veers north. That's the most dangerous time. In fact, low unemployment is always dangerous because you have no history, none, zero, of sustaining low unemployment. You can doodle for a year, if you're really lucky, for 2 years, but that's not typically what happens in a Fed rate hiking cycle. So, and unless the Fed dramatically cuts rates, which they're saying they're not going to do, although I'm always skeptical of believing a single word they say, for reasons mentioned, typically you would need an event to take place. And have I mentioned debt ceiling?
Right. Well, I definitely want to talk about that. But first, it's interesting to hear you say that we're maybe approaching the iceberg. Personally, I feel like we've already hit it. The Fed is, I don't know if you've seen these memes on Twitter, the Fed is actually playing the violins, pretending that, nothing's wrong. We're going down slowly and you'll all make it onto life rafts, which is obviously not the case. But I would say you probably agree that the bubble has popped. We just are not feeling all of the effects of the everything bubble popping. And like you mentioned, unemployment is actually decreasing, which is surprising because so many people have seen in the news information about layoffs and companies going bankrupt. And yet the labor market appears much stronger than you'd expect. Is part of that because people are working multiple jobs, or why is unemployment so low?
Well, for a couple of reasons there. First of all, again, lagging data. Okay, if you hear a layoff announcement, doesn't mean everybody's unemployed the next day. Those things also take time to filter through. Second, look at backwards revisions. In fact, the last labor report, the last couple of reports got dinged down, which is kind of ironic market psychology, because you present the better news, which is not real. And then you revise it down later, but then it doesn't matter anymore because you get the next good report, which then gets revised down as well. The other issue is simply statistics. I think we're all dealing with, and that kind of worries me about all of us, and especially the Fed, is are we looking at real-time data? Because let's face it, the BLS model is also heavily influenced by modeling birth death ratios and what have you. So a lot of this is actually not all as solid as we would like it to be. So again, we're kind of maybe in the blind factor here. In fact, if you go back to like previous recessions, you will only find out after the fact that we're already in a recession. I'll give it another example. Atlanta Fed produces this GDP Now model. They do it updated weekly, bi-weekly, what have you. And in Q1, they put out this model that went against far above consensus. At some point, had 3.5% GDP growth, while consensus was 1%. Well, guess what? In the last 2 weeks, before the actual report came down, their model just dived down to actually hit it perfectly. They got it right at the end, 1.1%. But I'm sorry, the variance in this is a bit, defying credulity at this point, and now they're doing it again, because now Q2 they're projecting 2.7%. No way, no hows. So, but this is how you inadvertently manage perceptions or create perceptions that things are a lot better. Mm-hmm. So we project 3.5%. We came in at 1.1%. It's just a slight margin of error.
It's huge.
I mean, come on,
well,
no.
This
No,
reminds
it's
me,
holding in. And
I
don't
don't know
forget,
if, do you recall in 2008 and 2009, I believe that they estimated that GDP growth would be 1.6 to 2.6%. And it contracted by 2%. They were off by threefold, I think. It's time for a quick break to hear these messages from my partners. First up, Bitcoin Conference 2023. The world's largest Bitcoin conference is returning to Miami Beach from May 18th to May 20th. Day one is Industry Day with a focus on business-minded panels and discussions, plus top-tier networking opportunities. General admission days 2 and 3 are open to all pass holders and feature panels, keynotes, and workshops with speakers like Michael Lewis, Michael Saylor, Jack Mallers, Lynn Alden, Arthur Hayes, and more. Plus some exciting new additions like the inaugural Bitcoin Games and the Mining Village, and the return of Pitch Day. I highly recommend this conference. It's what launched my career. And if you want to come, just head to b.tc/conference and use the code HODL, HODL, for 10% off. I'll see you in Miami Beach. Next up, Fold. Fold is the best Bitcoin rewards debit card and shopping app in the world. You can earn Bitcoin on everything you purchase, from Amazon to groceries to sprucing up your wardrobe, with Fold's Bitcoin Cashback debit card. And you can win free Satoshis every day, or even play for the chance to win a whole Bitcoin by spinning the daily wheel and the purchase rewards wheel. And now on Fold, you can buy Bitcoin directly and earn even more incentives and rewards by using the app to stack sats. It's an amazing app to get someone totally new into Bitcoin. So if you want to join the fun, head to foldapp.com/Natalie and get 10,000 in free sats when you sign up.
well, as I said, a lot of similarities to how things are managed in terms of the public communications. 2007, Fed report after Fed report says we expect a soft landing. It's exactly literally the same language. Ben Bernanke went in front of Congress was it January or February of 2008, and he says literally, and I quote, "The Fed sees no recession," when it was later adjusted to have started in December of 2007. So when he went in front of Congress and said, "Yeah, I see, with the Fed sees no recession," the U.S. economy was already in a recession. You cannot rely on any of these utterings to mean anything.
Right.
Okay. And that's how you get a Nobel Prize in economics, I suppose, right? No, I mean, this is why I go back to saying, this misguidance by the Fed and being caught off guard, this goes way back. I mean, 2008 is a good example. Inflation transitory is another great example. Misguiding this whole rate hike cycle is another one. And so now we're in this new world where in the olden days, there was no Fed speak. There was once in a while Greenspan every few months going in front of Congress or a Fed meeting or what have you, and he was the only one talking. And he was because of that, he was like so closely watched and everything else. But he was also very, very good at keeping things close to the vest. Okay. Yep. And there was no grand speculation. Now we live in this age. And I did a little thread. Well, it turned out to be a monster thread. I didn't intend to do it because I kind of made a joke after the previous last Fed meeting. I said, now it's time for 50 Fed speeches. And we actually got 45 speeches and interviews in a 3.5 week period. Bullard and these guys talking like 5-6 times a month. What for? What new information are you offering? And the worst part for me here is, because I have been critical on this, because all this constant jawboning, because markets are many times reacting to it. Right. But I think the Fed is actually shooting itself in its own foot, because invariably these speeches and utterances and prognostications show how terrible they are at forecasting anything. So they're killing their own credibility, which has now led us to this point. But the bond market is not believing a word the Fed says, which is right now they're saying no rate cuts in 2023. Well, the bond market has a very different opinion about that.
Right.
So, what are you going to do with a Fed that has no credibility with the market? That is a concern as well. So someone's going to be very wrong or right.
Well, let's talk a little bit about the debt ceiling. We heard Janet Yellen coming out saying that U.S. default on debt would trigger economic catastrophe. And I think there's going to be a little bit of a standoff, right? Because tax receipts are falling, the deficit's climbing. Powell wants to be Paul Volcker, but he doesn't want to be Arthur Burns, but he's going to be caught in the middle. So how do you see this playing out with the debt ceiling coming up?
Well, first of all, I have to agree with Janet Yellen. I find myself in rare agreement with Janet Yellen. If the debt ceiling is not extended, it would be a complete disaster. Let's not be too glib about this. The entire economy is based on debt expansion. All growth since the global financial crisis has been financed by debt. And I mentioned earlier, debt to GDP being twice what it was in 2008. Let's face it, this entire system requires ever more debt. And going back to your earlier question, actually, about why we haven't crashed yet or anything like that, we are still in a period where government spending is exorbitant. We had $1.1 trillion deficit in the first 6 months of this fiscal year. Guess what? That all counts towards the GDP. Okay. It is, and Janet Yellen goes out and presents a budget that calls for $50 trillion in debt in 2032, which I guarantee you is an underestimate. Okay. And the irony of this, of course, is when she was Fed chair, she was warning about unsustainable deficits. So does Powell. He's done that year after year after year. But then they create the policies that have facilitated all this. And here's the reality. And this is why rate cuts are coming. You're not going to have sustainability, be it 31 trillion or 50, never mind 50 trillion, with rates higher for longer. Interest payments on debt are going through the roof. And they're already exceeding the US military budget, which is the largest item in the discretionary budget of the US by far. By far. And so this notion that the US government, which, by the way, has rolling over debt this year and next year, that all have to be refinanced on higher debt, can somehow default on its debt payments or not increase the debt ceiling is ludicrous, because yes, you would have complete apocalypse and everything. So yes, they will solve it. They will solve it. The question is, how far are they willing to push it? And one example we have where things kind of went shaky for a while, that was in 2011, which ironically is kind of, this year's kind of playing the same way. If you look at market performance so far. And back then it was the market was duly making new highs for the year in May. Then it sold off a little bit. There was a little correction, and it went back up in June. And then the debt ceiling hit hard. Then there was a downgrade for US debt. And then boom, we had a major market melt-off. But guess what happened then? Guess what happened then? You know when markets bottomed? In 2011? The very same day, the Fed announced Operation Twist.
Wow.
Okay. Yeah. Boom. That was it. It was always, it always has been Fed to the rescue. So if Powell, for example, now that they've given 500 speeches about not cutting rates, and I'm completely speculating here, but if they want to save face and something bad happens this summer, debt ceiling, you name it, or bank credit, the debt ceiling would actually give them the perfect excuse to renege on everything and flip-flop. And that would be the end of it, because then you just got liquidity flooding the system again. And don't forget, Janet Yellen from the Treasury has already announced her own QE program, which starts next year. The Treasury is actually going to buy treasuries.
Right. Well, that's what I was going to ask, where will the demand come from? Because I think everyone knows by now they're going to raise the debt ceiling, right? It's a ceiling, but not really, in name only. So once the treasuries are issued, is the demand going to come from the foreign market? No, it's probably going to be us buying our own treasuries, right?
Well, that's the program where, you do what you have to do to make it happen. If the demand is not there, they'll do it themselves.
All right, so let's talk a little bit about the S&P, which you mentioned, because a couple of tech stocks are leading that index. And I read a book recently called The Psychology of Money, where it talks about over decades performance of indices and mutual funds. And it's just a couple of stocks sometimes in companies that outperform everything else and still allow for significant gains overall in, say, an index. But is what we're seeing more unusual, just seeing, Apple outperform and everything else sort of struggle to keep up? Or is this kind of par for the course with investing in general?
Well, there are clearly phases when you have some stocks leading. It's not a problem. It becomes a problem typically when it's exclusive at the rest of the market. I'll give you an example. I watch equal weight quite a bit. It's a cool little technical indicator, and I liked it at the beginning of the year. I was doing some Northcasts on it. It was outperforming. Remember, tech had been hammered last year, and it got hammered in early January. And yet the uptrend in tech was holding, which was very curious because it had every excuse to break the uptrend, but it didn't. And in that context, equal weight, which is when you measure all the stocks, not relative to market cap, but based on equal price, all of a sudden it was outperforming. It was breaking the downtrend that the S&P had, while the S&P had not yet broken its uptrend. That was a flag. That was a flag to me that said, I think we're going for a breakout. Okay, something is changing in the market, and it's a positive sign. Okay, and we got this big rally, we got this big breakout, and then we got the February correction. And I was watching that closely, and then of course the bank stress happened, and guess what? Equal weight has fallen off the cliff. And it's not only the broader market, but even in the NASDAQ itself. If you look at cumulative advanced decline last Friday, when NDX made a new high on the heels of Apple earnings, it made a new low for the year. It made a new low vis-a-vis December. It made a new low in this entire cycle. So the divergence that we see now is as dramatic as I've ever seen it. And I had to look it all up. And this is maybe the bullish argument. The only time it was this bad was in 1998. And we know what happened then. We got a big melt-up rally that ended up in the bust. But in general speaking, when things are that divergent, I want to be cautious because I want to know what that tells me. And it's not because only of banks, because we know banks are bad, but I look at transports, consumer discretionary. I mean, there's a lot of sectors that are in tune. You say markets are forward looking. Well, maybe these stocks are telling us something about the economy. And because the indices are going higher on the heels of these mega cap tech stocks, which, by the way, and I don't envy Powell, maybe, just maybe, he's dealing with a new bubble in there because of AI, right? I mean, AI looks fantastic. It sounds promising.
Right.
But we don't know that yet. We haven't seen the effects yet. So it's like everybody piling back into the next, I hate to say shitcoin, right? Because
that's any AI company,
it's the same investing behavior we saw in 2021. Just chase it. Right. And the biggest problem I have right now with this concentration is everybody and their mother owns Apple, Microsoft, Google, Facebook, you name it. Everybody, even if they don't own them directly, they own them through ETFs. The dominance is so great that if actually we do get a downturn, a recession, they're not going to be safe from that either. In fact, and this goes with my equal weight measure, while earnings have held up for these big companies, even though Apple's dealing with declining revenues and they're great at executing. I mean, these are, I'm not knocking the companies; they're fantastic. Okay, and they're great at executing. But because of their dominance, they also have the ability to manage things better. And smaller companies are much more vulnerable. And if you look at, and B of A had a chart on this as well, if you look at small caps, for example, their earnings are going down much harder, down 12%. If you look at previous cycles, that's your warning sign. Okay. The big company earnings rollover comes later. All right. They're still in this dominant position, and with the labor market still strong, and you name it, they're still holding up. So this is why this whole equal weight component to me is really important. So you got two simple scenarios. Okay. One of them is lying. So either the equal weight and the smaller companies are catching up, then you can have a massive melt up, a la 1998, or they're telling the truth. And if you look at it as on an equal weight technical pattern, it looks ugly as sin. And then we got new lows coming with a recession hitting due to lag effects and credit. And this is the period of discovery we're in right now. And I think that's why we're seeing in markets this back and forth chop that we've seen over the last month. And don't forget, when SVB happened, that rally that came right the very moment Janet Yellen got concerned and the liquidity was pumped in. It was pure liquidity. And Bennett and Bitcoin, everything else benefited from that as well. Okay. So speaking of the S&P, I was bullish because I saw the technical patterns. We had a beautiful descending bullish wedge building last year. It broke out earlier this year, back tested it, did beautifully. But now we're building something else. Potential, and I always emphasize potential until a pattern is confirmed. There's a potential rising wedge. It still has a little room higher. Doesn't mean it gets higher. But if that thing plays out, and I see the same thing on tech, then we're going to have a lot more volatility coming this year, which, by the way, has also been insanely compressed.
Oh, yeah, the VIX.
Going back to my Bear Stearns thing, it's hilarious how similar this is, because the VIX, when Bear Stearns happened, the VIX got crushed to 15.98 in May of 2008. And guess what the VIX just did? It got crushed. It's the same thing. I mean, history doesn't repeat, but man, it's rhyming all over the place,
Right. It's time for a quick break to hear these messages from my partners. First up, CrowdHealth, a Bitcoin alternative to health insurance. Health insurance costs can be sky high today, and you essentially send money every month to a massive corporation, the health insurance black hole, as I call it. And if you don't need any health care, you never see that money again, right? But if you do need to go to a doctor, you end up having to pay even more out of pocket, especially if you end up as one of the 20% of claims on average that aren't covered. With CrowdHealth, you pay a small monthly fee that goes into an account that you actually accrue over time and is yours to use or keep if you ever leave. You can even save that money in Bitcoin. CrowdHealth is all about community, and the community crowdfunds everyone's healthcare. So if something does happen or you have a doctor visit, CrowdHealth will negotiate down the medical bill much lower than what insurance would be, and then the community helps you cover it. And in return, you help others cover their needs. For more information, you can head to joincrowdhealth.com/Natalie. And if you use promo code Natalie, you get 6 months for $99. All right, next up, iTrustCapital. iTrustCapital lets you invest in Bitcoin for your retirement with the tax benefits of an IRA. You can defer taxes on gains using a crypto IRA, or with a Roth IRA, you can withdraw tax-free at retirement. And here are some important things to know given the recent crypto contagion. iTrust does not lend against client assets. iTrust accounts are also FDIC insured up to $250,000, and iTrust does not hold customer assets or money. Assets are actually held between Coinbase custody and a custody platform called Fireblocks. And Fireblocks, by the way, underlies pretty much the entire industry. So if you're doing retirement planning and considering adding Bitcoin to your IRA portfolio, you can sign up for an account and get a $100 bonus at itrust.capital/Natalie Brunell. Well, I want to turn back to the banks for a moment because it has been so fascinating to see some of these regional bank charts look like alt or meme coins all of a sudden dropping off a cliff. And, it has to be said that most of these recent bank failures have happened in the 12th district, a lot of them in California. Mary Daly, why is she not stepping down? I mean, it never seems like there's any consequences for the folks in the Fed in any of these positions when something goes wrong in the system. So I don't know if you have a take on that, why they're all happening in this particular district and region. And what do you see happening next? Because there are some analysts saying, well, okay, these bank failures have happened, but nothing has been systemic. And we are seeing more and more consolidation into the bigger banks. But what's happening and what's on the horizon?
Well, to your comment about no consequences, yeah, I mean, it's absolutely baffled. But if you're on the Fed board, it's the best job on the planet because you can. There are no consequences. I've never seen anyone get fired. I mean, the only guys that ever had to face any consequences, they got to resign and on the insider trading bit. Right. But if you look at Powell, I mean, think of the things he's overseen in the last 2-3 years, right? From getting inflation transitory completely wrong, the insider trading scam. Now the banks didn't see that coming at all. It's concerning. I mean, that's why I go back to maybe you shouldn't give 50 speeches a month. Maybe you should actually stay on top of things that are going on. No, the bizarre thing with this one was that with SVB, for example, not only Mary Daly, I guess asleep at the wheel, the CEO of the SVB Bank was on the board of the Federal Reserve Bank of San Francisco. I mean, this is not confidence inspiring at all. So to say, well, the bank executives should have seen this coming. Well, why wouldn't they see this coming? He was on the board. I mean, it's the level of just incompetence is actually frightening. The thing with these things is you just don't know what you don't know. And let's face it, none of the Fed saw this coming. No warning signs whatsoever. This is the typical cycle when the Fed raises rates until something breaks, right? And these things are showing cracks in the system already.
But how many more banks have to fail for it to be broken? Because I've seen those charts recently shared on Twitter where the amount of financial loss is already bigger than what happened in 08-09 with those failures. So I guess it's just because we had so much liquidity in the system that we're still going. But I mean, how many more banks have to fail for it to be truly systemic?
Well, I'm not sure it's going to be systemic because they're painting right into it, right? I mean, they've shown that they're willing to intervene. Be fair to them, stockholders are taking a bath this time, right? It's not a bailout like we saw in 2000. Yeah. But in essence, go back to Janet Yellen right when SVB happened. She talked publicly about we will only secure deposits if it's a systemic event. Well, since then, we had several more bank failures and they secured all deposits. So they're basically given a blanket deposit guarantee to everyone, which is not exactly, I mean, I understand why they have to do it, but don't tell me then, only it's systemic when all of a sudden everything is systemic. Oh, but it's not a systemic. Well, you're treating it like it's systemic or could be systemic. The issue is it's not going to go away because rates are still high and they're going to continue to be high. They just raised rates some more last week, right? And so the core issues with portfolios of these banks, there's hundreds of them that are underwater. And if you're talking about confidence in the banking system, you need to see a sustained rally. I mean, I'm actually shocked at this point because if I look at CRE, the regional bank index, it's trading way outside the monthly Bollinger Band. Typically, that's not a place I want to short at all. And I'm not touching these things anyway, because that's technically where you get a big relief rally. We saw that in 2008 as well. But if you have a bunch of banks trading outside the monthly Bollinger Band to the downside, you have no sign that anything is secure and safe. That's what I'm saying. If you look at even BKX, which is the broader banking index, it's trading terribly. So, saying the system is safe and sound and stable, then show it to me in the charts. I don't see it yet. So I don't think we're in the woods, out of the woods. And frankly, I think the Fed knows that now too, especially it relates to credit tightening, because that's where your systemic issue comes from ultimately, because this is like turning off the switch on the economy, and then things can get bad very quickly. And again, it may take months, it may take a minute, maybe at a larger bank, who knows? You know, unclear at this point. But it's ironic that we went from too big to fail. You know, 2008, that was the big concerns. That was the point of all this regulation, and to broaden things out and don't let banks get too big. Well, now we got big banks gobbling up the smaller banks again. So you can get into concentration issues.
Right. I want to talk to you for a moment about inflation, because obviously with a decelerating economy, we have seen inflation come down. And remember, everyone, it's still, prices are still going up. The rate at which they're going up is just slowing, thank goodness. But I wanted to hear from you, because some folks I've heard out there say that we're actually going to see a negative inflation print this year, and others say, no, we're going to be in double digits. There's such a disparity in the views out there. What's your take on inflation?
Well, a couple of points. One is, a lot of the inflation that we saw was systemic in the sense of supply chains. The part of it was COVID related shutdowns, and the other one was driven by excessive demand as a result of overtly loose monetary and fiscal policy. They just overstimulated, and so they overwhelmed the supply chains. That was the original sin by Powell and his cohorts, to just keep printing, you know, when CPI was already over 7%, right? And now obviously we see the fallout of them trying to catch up. So some of that, as it's related to supply chain and you know, shutdown related, that inflation was always going to come down. That's not the issue. The issue is what they've propagated in the fallout of that. You know, the step to raise rates quickly was, given the situation, the right one. If you look at past inflation cycle, you mentioned Volcker earlier, you know, this guy went aggressive. You know, you got to get the Fed funds rate really high above inflation to slow down the economy. And historically, the solution was always the same. You need a recession to really get rid of inflation. Because if you look at, you know, some of the inflation items, airline fares, they're still going up.
Oh,
right?
yeah.
Wage pressures are going up. And now we had all of a sudden a few $100 billion in liquidity coming in, and markets holding up. Guess what? That creates wealth effect. Wealth effect has consumers spend more. The other issue is credit. I mean, the consumer keeps piling into credit, which is, you know, kind of terrifying, because, you know, interest rates on credit cards are over 20% now.
Right.
They've ballooned up dramatically. Now, is it because consumers are incredibly confident, or is it because consumers are really struggling because their wage growth has not kept up? Now, the one positive here is, because inflation is coming down on a relative basis, we're finally seeing, after like almost 2 years, wage you know, net wages, real wages, actually go into positive territory, but they've been in negative territory for almost 2 years. Right. And that's not typically a good thing either. So you still have all the spending, and the concern is that it actually, with unemployment being this low, that it prolongs the inflation fight, you know. And no one's going to say this from the Fed, okay? The solution to get rid of inflation fast is a recession, because it just disappears. Even Volcker cut rates when CPI was still north of 10%. Why? Because the US economy was going into recession, and boom, inflation disappeared. But no one's going to say that, because that's not a good marketing tool. And the other issue is, we have a presidential election coming next year. So I wonder if they're making a mistake politically, because, you know, maybe if you want a shallow recession, you want it sooner and get it over with. as opposed to dragging this out. Inflation becomes stickier, and they're going to have to stay higher for longer, and then the damage is going to be worse down the road. So if you don't get a recession this year, fine, but if you didn't get it in 24, that would be ugly.
It's really amazing to me how much we can kick the can down the road. I think at this point, pretty much everyone is expecting a hard landing, a pretty severe recession. The last place I want to leave this conversation is Bitcoin. What is your short to medium term view?
Well, Bitcoin, technically, I mean, like last year, I think we spoke in the summer, right? Bitcoin got the hammer down to 17. It was, and I spoke with Michael Saylor at the time too. And then my view was just add on weakness, right? And then we got this big rally now into 30,000. And I look at this also technically, and again, the relationship with liquidity is so paramount there as well. And that's why we just, when they added liquidity during the banking event, Bitcoin went right up with it. But I'm also a technician, and technicals keep me honest, Natalie. And what's happened here is Bitcoin had a big trend break last year, big one. And this rally just now got it right back up to that uptrend, that broken uptrend. And there is a moving average. It didn't quite get there. And now, like I mentioned on the S&P, like I mentioned on the NASDAQ, I see a rising wedge. I had a bullish falling wedge when it went down to 17. It builded beautifully on a positive divergence, broke out, but now it's hit key resistance. So unless these patterns invalidate themselves, I would not be surprised to see some more downside coming. As long as you hold like 22,000, I think it's okay. But if you break below 22,000, things could get gnarly again. And I'll finish on this note, because this liquidity chart I mentioned, bank reserves is really important here. If you look at bank reserves, the Fed publishes this every Thursday. If you look at bank reserves vis-a-vis the S&P, NASDAQ, Bitcoin, you name it, since they started reducing bank reserves in January 2022, every time it goes down, S&P goes down with it. Every time it goes up, S&P follows suit. We only get this information once a week on a Thursday. So unfortunately, I would love to have it as a live ticker almost, right? Yeah. But there is a lag effect. Yeah. For example, just be absolutely clear, the big lows last year, June and in October, came when bank reserves bottomed and started trending up again.
Interesting.
The June rally extended with bank reserves going up into August. Another example in this chart, April is typically a bullish month for equities. Last year, it was not. Why? Bank reserves went down. And this recent bank event we had, they just added tons of reserves.
Right.
And they're starting to pull that back again. Okay. So we're going to have to watch this very closely here into late May and see if we're going to pull back effect on equities. So far, we haven't. I mean, tech is still driving everything. Even last week, you know, we see these intermittent weaknesses and then these big, massive rallies up, and VIX crush on Friday. That program remains in effect. No, it's amazing. I mean, all these rallies this year, vertical up. When there's a rally, it goes vertical up, no price discovery, VIX crush, the end of it. Wow. On to the next. You know, it's very programmatic at this point.
Really fascinating. I really appreciate your technical analysis. And you know what? I'm in the camp that I would actually like to see Bitcoin go down a little bit. I should have bought more when it hit the 16, 17,000 range. But you know, that fear comes in and you think it's going to go even lower. Unfortunately, my target buys at 10K never happened. So
well, the cycle's not over yet, so who knows? May still happen. Look, I mean, I hate to say it. I mean, last year was hoping that by the end of last year they would get their regulatory efforts in gear, and we would actually have clarity. We still don't. And Janet Yellen is not Bitcoin's friend. You know, So there's still things to come on that front as well. So I'm staying patient.
Well, I know you're long-term bullish. So Sven, thank you so much. Any parting words, final thoughts for the folks out there investing in Bitcoin and across the financial markets?
Well, I've been highlighting some risks, obviously, in these markets and concerns that I have. But I'll also give you one other thing to look at. It's quite fascinating because, we all have our views of what could happen. But, at the end of the day, you got to trade the markets you have and not the markets you want. And, the most dangerous words in trading is probably the market should do this, but it's not, but I'm sticking to what I think it should do. And there is a basic, simple S&P seasonality chart that I keep watching. And it's fascinating because so far this year, it's played it perfectly. It called for a big rally into early February, a pullback with a new low into March for the year. Then that pullback would stop in the middle of March, then a big rally up to early May, then maybe a pullback into May, another new high in June. And guess what? All dips are buyable. And based on that chart, I will just say, look, my opinions, take them for what they're worth. I mean, I'm trying to make sense of the macro and the technical. Yeah. But that chart, unless it invalidates itself, I'm going to be respectful of it because it could say new highs are coming, right? So before any other thing, like 98, who knows? If you get the right combination, soft landing, Fed pivoting, it's all possible. It seems unlikely to me based on my analysis, but I'm going to stay open-minded, right? That's always the challenge. You got to challenge yourself in all this.
That is great advice. Thank you so much, Sven. It's great to see you. Hope it's in person someday soon. We're headed to the Bitcoin conference and we're going to miss you there. But thank you so much and we'll talk to you soon.
You got it. Thank you very much. Thanks for having me.
Thank you so much for checking out this episode of Coin Stories. Again, hit like on the video and make sure that you have those notifications on so you don't miss out on any new episodes. And I would love to hear from you. If you have suggestions, feedback, guest requests, please email me at natalie@talkingbitcoin.com. Thanks so much.